Good evening, everyone. I welcome you all to today's webinar, wherein we shall be trying to learn and update ourselves with a few aspects of Section 9 of Income Tax Act and its impact on the non-resident taxation. I welcome the esteemed audience and extend my heartily welcome to CA Piyush the Chairman of Direct Tax Committee, CA Kota Srinivas the Vice Chairman of Direct Tax Committee, Mr. S.P. Singh, who is an ex-IRS, and our today's speaker, CA Prasanna. I request CA Piyush to give a welcome remark. Before that, I would like to speak a few words about our esteemed Chairman of DTC. He's a chartered accountant in practice who has been in the line for last 24 years. He specializes in direct and indirect tax appellate proceedings and arbitration proceedings. He has been a speaker on various topics of direct tax, a member of Working Committee of ASEAN Federation of Chartered Accountants, ASEAN Federation of Accountants, a member of External Committee of RBI, Asset Reconstruction Committee, and a vital contributor of WIRC's publication of Vivad Se Vishwas scheme. He is also a practicing litigation in direct as well as indirect tax. I request CA Piyush to give a welcome remark. Over to you, sir.
Thank you very much, Deepika ji. A very good evening to all of you. My Vice Chairman, CA Kota Srinivas ji, Speaker and Faculty for the day, K. Prasanna ji, Moderator Deepika ji, Advisor to Direct Tax Committee, SP Singh Saab, our other office bearers, Prachi, Priya ji, all the participants, a very good evening to you. Once again, warm welcome to you to this international tax session, which we generally have on every Thursday. As you are aware, that it is positively held wherein we choose a topic of a direct tax on one Thursday and alternately we take an international tax. First of all, I would thank K. Prasanna ji for accepting our invitation and covering a very important topic, which is the Section 9. I'm sure it's the most important topic. Most of participants, most of members across India would feel that I'm not practicing in international taxation. But you may know that once you are issuing a 15 CB or a 15 CA, if you are actually filing for your client, you should have to know the basic provisions of Section 9, because you are giving your opinion as to whether the applicability of Section 9, whether the tax is to be deducted or not. And therefore, Section 9 becomes a very important concept. Individual tax practitioners or individual person who may feel that I'm doing only work on direct tax, but he may be doing a small certification on 15 CB, he should be cautious about it. And I'm sure the next 2 hours will be a great learning experience for you. Being a direct tax committee chairman, I'll just touch upon 2 or 3 important things which you should look forward to in June. Obviously, I'm speaking on this since the last 2 months. Now I'm on the verge of releasing it. I'll just update you on that. That is implementation guide on revision of Form 3CD. It was almost finalized by the group yesterday. In fact, today there was a parallel meeting to be held along with this webinar, but that has been postponed. I'm sure in a day or two we'll be able to finalize, and before the end of the June, that implementation guide on revision in Form 3CD, which will cover more specifically on 43B subclause H, for which all the members are waiting. My request to you, when you're discharging your tax audit function, please do look into this implementation guide. Do follow that. It will help you in ring fencing you. Whenever you are put to questions about the assurance functions, how you have dealt with it, you can always fall upon stating that you have complied with the implementation guide or a guidance note on tax audit. Similarly, as I mentioned earlier, the implementation guide on audit of charitable institutions in Form 10B and 10BB has been converted into a guidance note. Exposure draft was already released. We have received total 87 comments. The exposure draft was open up to 28th May, and we have received quite a bit comments running into 87 in numbers. Those changes have been looked into by a group which was formed for that. Once a group decides, those changes will be incorporated. And since it is a guidance note, which is mandatory in nature, though it says it's recommendatory, but the auditors are expected to follow that, because in case they are not following, they will have to document and state the reasons or what alternative procedures were done which were not in conformity with the guidance note. So it requires an exposure draft. Once this exposure draft changes suggestions which we have received is incorporated, will go to the council, which is scheduled to happen on 2nd and 3rd of July. If council approves, Please believe me, by 10th of July, you may have the copy of the guidance note available, which will help you and assist you. Other important aspect which I thought would like to bring out, which is quite late. Yesterday evening itself, we have come up with a Google form. Lastly, you may be aware that there was a matter pending between with the Supreme Court, whereby whether the institute could prescribe the maximum number of tax audit that can be carried out by a professional chartered accountant. The powers of institute had been upheld by the Supreme Court. There were certain cases which were pending before the disciplinary committee in respect of those members who had done audits beyond limits which was 60 or 40 at that moment time. At the same time, because Supreme Court said that you may, because there are powers and the institute and council should review those guidelines time to time. And the last limit was increased, which has elapsed quite a bit of time. We have decided at Direct Tax Committee that we will review this, that whether the limits prescribed for tax audit needs to be revised or not, maybe upward, maybe downward, whatever. For the purpose of which a form has been circulated and it has been sent to members of the Institute of Chartered Accountants of India for seeking your opinion thereon. We are also trying to circulate through WhatsApp. Whosoever participants over here who have received that form, you may share with your friends, chartered accountants, and also take their opinion. We would like to have a maximum opinions, maximum results coming up. So it will help us in analyzing. And if you fill up the form religiously, you will know, because it also states whether you are a proprietor, you are a partner, how many tax audits you are doing, what is your recommendation, whether I should go down, whether I should go up, how much I should go up, and that will, from which area you belong to, that will help us in analyzing by the Direct Tax Committee and ultimately go to the council with our recommendations. So please do write. That form is open up to 9th. If you have not received, you can also find that Google form on our DTC page of Institute of Chartered Accountants of India's website. So please do look into it. It will definitely help you. Apart from that, my request to you, I've been listening, a lot of issues do arise during your practice era wherein you find difficulty with the assessment proceedings, with the intimations received under Section 143 subclause 1. My only request to you is that DTC committee of ICI is very proactive since last 1 year, along with my vice chairman and my team. Whatever suggestions you have, whatever recommendations you have, whatever problems you are facing, please do write us. You may, an individual chartered accountant, you need not approach your statisticals branches chapter. You may directly write to dtc@ici.in. I and my vice chairman can assure you, whatever suggestion comes from you will be taken up, will be discussed by us, will be, if required, will also discuss at the committee level and also escalate to the CBDT. CBDT have assured us that whatever suggestions do come, whatever representations are made through the Institute of Chartered Accountants of India's committee, they will look into it. And also on a quarterly meetings, which we have proposed to help with the CBDT team, those written representations. My request to you, so whatever issues you have, please do escalate to it. Do not think that whether it would be considered seriously. I can only assure you now that it will be considered seriously. So once again, thank you very much. Please do look at it. We are coming into an income tax season. 31st July would be due date for filing of returns. And then there is an audit season. I know it is quite a busy season, 3 to 4 months coming up. Please do well and please be attentive to this webinar. I am sure you would be benefited immensely. Section 9 being a very important topic. I know there would be a questions and answers in your mind, which you can put up in the chat box also. I am Deepika, the moderator. She would be looking into it and she will do her best to address all those questions and put forward to the faculty and address best its ability. Thank you very much once again. Thank you, Deepika. Please take the proceedings forward.
Thank you, CA Piyush ji, for your nice remarks and a good update and a good setting for the webinar. Now I request CA Kota Srinivas ji to give the opening remarks. Before that, I would like to highlight a few words about him. He has served the Institute for over 2 decades. He has been with the Institute as a student, and now he has been serving the regional council member. He has been the regional council member of SIRC of ICAI. He has brought many initiatives, which include conducting ARRC, which is Annual Regional Residential Course on International Taxation, and he's successful in conducting five ARRCs on international taxation as well. He was instrumental in developing a digital project for SIRC, an improvised IVR system for members and students, which is available in 6 languages. And he was also extremely instrumental in collecting around 1.5 crores towards the CA Benevolent Fund in the year of 2017 and 18. He has been the pioneer of think differently and act perfectly. Over to you, Kota Srinivasji, for your opening
Thank you,
remarks. For your opening
Deepika.
remarks.
Yeah. Thank you, Deepika. First of all, let me welcome all of you for this webinar on international taxation subject, section 9. Let me also welcome the chairman of DTC committee, Piyush Chatterjee, and speaking sir, who is always guide and I should say strength for this DTC committee. The speaker of the day, K. Prasanna from Chennai, and Deepika, who is moderating this particular thing. Welcome to all of you. Also, we are having our Secretary of DTC and other staff members, Priya, Pachi, and others. First of all, let me thank Prasanna for accepting our invitation to be part of this and to talk about Section 9. In fact, Section 9 we are divided in two parts. This today, Prasanna will be taking a few of the sections of Section 9, few of the provisions of Section 9, and in the next week there is one more speaker, Chaitanya, will be taking the second part of Section 9. Why is it the Section 9 to be discussed in two parts? Just to tell you one story in for our Hindu mythology, I should say, like we have Mahavishnu, where we have he had Dashavatara. So one of the avatars in Hindu scriptures is the Vamana Avatara. He comes as a small boy, but he will measure the entire universe as such, which all of you are aware of. This section 9 is also like Vamana, where it is a very, very small section, but it can cover the entire universe. And once you get into the each and every clause of section 9. So this is very difficult to understand the section 9 within 2 hours or 4 hours, but we have made an attempt to take you through some of the provisions of section 9 as such. So section 9 has got 8 subsections, 9.1 to 9.8. 9.1 covers almost all the heads of income, excluding the income from salary. It covers income from business, it covers income from house property, capital gains, other sources. 9.12 and 9.13 deals with the salary income. Then 4, 5, 6, 7, it talks about DIRT, DIRT, dividend, interest, royalty, and fees for technical services. And last section, that is subsection 9A, deals with any sum of money received from a resident from a non-resident. So these are all the sub clauses of section 9.1. But if you go into detail, there are a lot of things one needs to understand. As the section says, income deemed to accrue or rise in India, there are a lot of things as a resident or a non-resident may receive in the general transactions many amounts in the country. So there are certain situations where a non-resident receives a amount outside India, and also it will be charged to tax in the section 9 as income deemed to accrue or rise in India. So there are some situations where the non-resident may be outside India. The transactions would have taken place outside India, but still it is taxable. So there are a lot of things which one has to understand in this particular section. I hope both Prasanna and in the next week Chaitanya will take us through this section 9 in detail, and definitely it will help all of you. As our chairman said, we are getting into the mode of the filing of returns and finalization of many accounts. So we may come across cases where a non-resident income is there, a person resident having certain income outside India, then you may have to see what are all the things that needs to be charged to tax. So before understanding section 9, a little bit of section 4, 5, 6 also is very much required. I hope a little bit Prasanna may cover 4, 5, 6 and then go for section 9. Once again, I welcome the speaker and over to you, Deepika. Thank you for accepting our invitation to be a moderator, Deepika. Over to you.
Thank you, sir. Thank you for your words. Now, I request our esteemed guest, SP Singh sir, to give an overview of the session. Before that, I would like to speak about him. He is the guiding light for this session, and he has been with the IRS for decades. He held various positions, including the Director of Income Tax International Taxation and the Commissioner of Income Tax Appeals. He has been instrumental and he's participated in negotiation of tax treaties with more than 30 countries and has taken part in mutual agreement procedures as well. He's currently the senior advisor to the ICAI and he's a regular faculty with the National Academy of Direct Taxes, ICAI and IIM Lucknow. He has been named by Euromoney and Legal Media's Guide among the world's leading transfer pricing advisors, and International Tax Review has recognized him as one of the global leaders in tax litigation for the year 2015, 2016 and 17, and also as a leading TP expert for the year 2014, 2015, 2016 and 17. He has co-authored several white papers on international taxation and transfer pricing matters such as APAs and safe harbor rules and has co-authored many such books. I request SP Singh sir to just guide us and give his opening remarks.
Thanks, Deepika, for nice words. And good evening, friends. Welcome to a session, rather a couple of sessions on one of the most important topics in the Income Tax Act, that's Section 9. As C.A. Kotaji said, and he referred to Hindu mythology, I was just wondering, can it be extended? And can we say that the trinity of tax law are Section 4, Section 5, and Section 9. These are the three pillars on which the entire tax law is stand. The other sections in the Act are either supporting, expanding, or are creating the implementation tool for these three sections. That's why this section is very, very important. Friends, whenever you think about taxation, there are several things which may be coming to your mind. How is taxation perceived? And what does it want to achieve? And what are its scope? We will be focusing more on the scope, but a few words about the perception. The tax is perceived as one of the two facts of life. One is death and the other one is taxes. And even the great scientist Albert Einstein said that the hardest thing to understand in the world is the income tax law. Friends, this is what the brightest mind of the generation, this generation, earlier generation, and generation to come has said. So it is very important for us to understand, and we are fortunate. We have very learned speakers, Prasanna ji today, and it will be followed by Chaitanya ji in the next one. The beauty of income tax law is that it always starts with an extreme. Either too broad or too narrow concept is brought in. With the passage of time, the policy makers start looking at whether it is being used to evade tax or avoid tax, or is it creating too much a problem for the business? Now a balance has to be struck. The tax law should ensure that the government gets its right pie. And at the same time, it should not create hurdle for the business. Trying to achieve the balance makes the law very, very complex. You must have seen many sections expanding with the passage of time. This is the balancing act which the tax policy makers try to achieve. Friends, while residents are taxed on the global income, the non-residents are taxed on the income which is related or which is attached to the source, which we call the source-based rule. And so far as the resident is concerned, as the global income is subject to taxation, there is no need to expand it further. But when it comes to non-residents, and as I said earlier, in case of non-residents, the source-based rule predominates. If you read Section 9, and when Prasanna ji will explain to you, it is not the global income which is being sought to be taxed. only those income which are economically related to India are sought to be taxed. Now, this gives, I won't say nightmares, but yes, cause of concern to the policy makers. Is the law good enough to cover all types of income in the hand of the non-resident on which they should pay taxes in India? Is there need to expand the scope of the tax law which is relating to the non-residents? This effort or this thought has always been the reason behind increasing the scope of taxation for non-residents. And one of the most important aspect or a step which has been taken is the introduction of the word deemed. For your benefit, I will like to refer to Section 5 of the Income Tax Act. It defines the scope of taxation of non-residents as well as of resident. In case of non-resident, it covers income which is received or is deemed to be received in India, or which accrues or arises or is deemed to accrue or arise in India during a particular year. Now let us look at this term deemed. It appears for the first time in Section 5. From where does this word come from? This word comes from the word deem, which means to consider or to judge something in a particular way. It is deemed to be like this. That's the concept. But when it comes to taxation, a deemed income is a concept in income tax law that refers to income that is not actually received by the taxpayer, but it is still considered taxable as income under defined circumstances. Mark my words, under defined circumstances. Because deeming cannot have infinite scope. There has to be a limitation put to that. Prasanna ji and Chaitanya ji will talk about how these things come into effect. So, the income is deemed to have been received by a taxpayer, even if he has not received it in reality. Now, friends, what does this deeming provision try to achieve? There are three things which the deeming provision try to achieve. Number one, sometimes it is used to impose for the purpose of a statute an artificial construction of a word or phrase that would not otherwise prevail. That is why in many sections you will read, subsections or proviso or explanation which goes on to explain the meaning of the deemed provision. Sometimes it is used to put beyond doubt a particular construction that might otherwise be uncertain. To explain the word, meaning of the word, this word is defined in the statute, either in the act, in the section itself, or subsection or proviso, explanation, etc. Friends, this deeming provision is enshrined under the Income Tax Act in respect of the non-resident under Section 9 of the Income Tax Act. And as Kotaji rightly said, it is very, very significant section, and it has expanded. You can give simile from the mythology or from biological things like amoeba. It goes on, multiplying and increasing in number. But it has expanded, and it has expanded because, as I said earlier, the tax policy makers try to ensure that the law keeps pace with the technological developments which are happening, which are making the old tax law archaic. Gone are the days where the brick and mortar business model were adopted. Now, in the digital world, you can observe, you must be seeing that services can be rendered and knowledge can be imparted, can be conveyed without a physical thing. Online, on the real-time basis, the models, the maps, the knowledge or the procedures are conveyed across the globe. How to cover them? The law, the earlier law, when it was enacted, is not good enough. It needs to be covered. And that is why there have been several amendments in Section 9, which will be explained by Prasannaji. I once again thank DTC of ICAI to organize this two-part discussion on one of the most important sections in the Income Tax Act. And we are very fortunate to have Prasannaji for taking up the core issues in Section 9. And knowing him, he will be one of the best person possible to discuss this. Over to you, Deepika.
Thank you, sir. Thank you for throwing the light and giving a beautiful overview of the today's session. Now, I would like to introduce today's speaker, CA Prasannaji. A few words about him. He has been a chartered accountant and a commerce graduate with more than a decade of experience in corporate and international tax and transfer pricing. He's won the FIT Fellowship Scheme from the Foundation of International Tax for 2018 and 19. He's been a regular speaker with ICAI and study circles and International Fiscal Association and has contributed many articles on the contemporary issues. He has contributed to the book on demystifying Section 194R published by the Tax Sutra. I welcome you all and I request Mr. C.A. Prasannaji to start his session. Thank you.
Thank you, Deepika, for a kind introduction. Thanks to the DTC committee, the chairman, vice chairman, as well as SP Singh for setting the tone for the session. Let me share the screen. Like Kota sir pointed out from the mythology, like how we highlighted that Section 9 being a Vamana, that it tries to measure the world, but it could only measure the earth and the sky. So there is a shortfall in the measurement by Vamana. So the same thing. The amount of content we have in Section 9 is so vast. So therefore, I don't know whether I would be able to do justice to the session, but nevertheless, I will make an attempt, humble attempt. Already the tone is set by the chairman, vice chairman, and then the moderator, SP Singh sir, with regard to the scope of total income and then the charge. So if you look at, to briefly touch upon the scope of total income, Section 5, it talks about timing, it talks about person, and it talks about place. So these are the three aspects which it covers. By timing, it talks about in the previous year because your total income is computed for a previous year, except for if you look at Section 4, the proviso to Section 4, there are specific instances where the total income is computed not for the entire previous year. Say, for example, Section 172, where in case of a shipping companies, if the ships were to leave India, then there is an obligation casted on the agent to submit the income tax return up to the date of leaving India. And then discontinuance business, Section 174, and then the companies which are into liquidation, there is a obligation on the assessing officer to assess an income up to the point of liquidation or up to the point of discontinuation of business. So these are some of the instances where the total income is not computed for the previous year, rather for a part of the year. Now, with regard to the second aspect, place, if you look at in Section 5, be it Section 511 or 512, it does talk about the place of accrual or arisal in India. So therefore, in India or outside India is referring to the place. And then with regard to person, you do have a classification between resident and non-resident. Like SP Singh sir pointed out, you do have three limbs for resident: accrual or arisal in India, accrual or arisal outside India, and then there is a deeming fiction is on one side of it. And then you do have receipt or deemed to be received in India on the second part. When it comes to non-resident, you do have only two limbs: accrual or arisal in India or deemed to accrue or arisal in India or received or deemed to be received in India. You don't find accrual or arisal in India for the taxation with regard to the non-resident. The aspect is, like Sir pointed out, there is no economic allegiance of this particular income with India. So therefore, I can't. India as such, if you look at, cannot exercise its sovereign rights outside of India. So therefore, the scope of taxation with regard to the non-resident is somewhat limited. Now, with regard to the deeming fiction, we do have two set of deeming fictions. One, Sir has already pointed out, a deemed receipt. In specific instances, if you look at section 7, any accrual on the provident fund, where although you don't receive that amount, but acts create a fiction that despite the fact you have not received the amount, I will deem it to be received. The amount accretion in the previous year to the balance at the credit of an employee participating in a recognized provident fund. Then the second concept of deemed receipt will come in section 198, where whatever TDS that has been deducted by the parties while making a payment or creating a credit in favor of you is deemed to be received by virtue of section 198. So therefore, these are the two fictions when it comes to deemed receipt. When there is no actual receipt, but still it makes it to be a receipt. But unlike this, deemed receipt, let's look at some principles of deeming fiction under section 9. Is there any difference between deemed receipt versus deemed accrual? If you look at this particular clause, it says income deemed to accrue or arise in India in following situations. So therefore, what it tries to do is it shifts the locale place of accrual from outside India to in India because of some nexus. There could be several other nexus, like Kota sir pointed out, you do have 8 subsections. So these are the factors that creates a nexus between an income which is accrued for a non-resident outside India and push that accrual into India by creating a fiction. So therefore, if you look at the difference between section 9 fiction versus deemed receipt fiction, in case of a deemed receipt, something which you have not received, it deems it to be a receipt. Whereas when it comes to section 9, it cannot automatically create an accrual. Accrual has to be as per section 5. But it creates a fiction by shifting the locale of that particular accrual outside India to India because of some allegiance. If a particular income is already taxable on receipt, then the purpose of section 9 does not come into operation. And the one another important aspect we have to be looking at is if a particular income of a non-resident is already accrue or arise in India, then the question of looking at section 9 does not arise. This has been held by the Supreme Court in Performance Rights Society. So therefore, we have to be mindful of application of this situation only in a case where when there is an actual accrual outside of India. If the accrual is already in India, then I don't have to look at. Then the relevance of section 9 will be applicable for non-resident, resident, not ordinary resident. Because in case of a resident, income accrue in India or outside India is anyway taxable by virtue of section 5(1). So therefore, this is relevant only for non-resident and resident, not ordinary resident. Moving on, if you look at the construct of section 9, 8 pillars of section 9. If you look at 911 as 4 limbs, business connection, I would in fact dissect the business connection into 2. A traditional business connection and then a business connection on account of significant economic presence. Then you have property in India, asset or source of income in India, and then transfer of capital asset. Then when it comes to salary earned by a non-resident in India, and if a salary is being paid by government of India, this is 2. And then you have dividend paid by Indian company, interest, royalties, FTS, and gift taxation. Gift taxation is limited to receipt of a sum of money. The word property is not covered under 918, whereas if you look at section 224, limb 17 or 18, read with 56.210, it also covers properties. So therefore, if you look at in 56.210, it covers property, whereas when it comes to 918, it covers only a sum of money. So the scope of discussion today, we're going to focus only on 9.1, with deals with business connection, property, assets or source of income in India, transfer of capital asset, and then salary part. The second part of the discussion, dividend, interest, royalty, FTS, is taken in the second part. If one were to wonder, explanation to section 9.2, it gives priority to interest, royalty, and FTS in case of taxation, irrespective of the non-resident as a business connection India or not. This came out of the Supreme Court decision in Ishkiwajima Harima Industries, and then followed up by an amendment in 2007 and then 2010. So therefore, the priority of application of section goes to interest, royalty, and FTS. But nevertheless, we thought, okay, it is first look at what is constituting a business connection and what are the specific limbs of business connection, then we moving on to interest, royalties, and FTS. So therefore, we shifted the priority for our convenience. Now moving on, business connection. If you look at the word business connection, there was no definition until 2003. It was always interpreted by the courts right from section 42 of 1922 Acts. There were, if one were to trace the origin of the definitions, one can go up to Rangoon High Court in Visalakshi Archie, where the case of the individual giving loan from British India to a Burma. So whether this stray aspect of loan which has been given from Burma to British India, whether that is taxable or not. The court went into the income tax and to see whether the aspect of business connection is defined or not. While if you look at section 2, it do define the term business, but it never defines business connection. We'll come to the 2003 definition in a while. But if you look at the Rangoon High Court, what they've said is the expression business connection must denote something which produces profits or gains and not mere a state or condition which is favorable to make a profit. So therefore, what it essentially says is there has to be some activity in India which could contribute to the profits or gains for the overall business. If there is no profits or gains to the overall business, then per se there is no business at all. If we were to look at why the profits and gains has been given so much of importance, take for example Article 4 of any of the tax treaty. You do, or rather Article 5, which defines permanent establishment. Their sub-article 4, or rather para 4, refers to preparatory or auxiliary related activity. Why any country has to give an exception to a preparatory or auxiliary, despite some of the activity could constitute a fixed place PE? The aspect is somewhat explained in National Petroleum ruling where, see, the preparatory or auxiliary activity in such a way, it is so remote from profit generating activity, it is difficult to do an attribution of profits for that particular activity. So therefore, the treaty has carved out if some of the listed activities has been carried out by a non-resident in the source country, then the source country will not tax that particular activity. So likewise, so there has to be some contribution to the profits or gains of a particular business. Only that particular activity could constitute a business connection. So therefore, the Rangoon High Court went on to describe the business connection, and they have also highlighted that the word connection has to be something not a stray activity. So there has to be some element of continuity should be there for us to establish a business connection. And courts have consistently held that I don't want to define the term business connection. Why is it so? Like SP Singh sir pointed out, if you look at the way in which the business has been carried on 40 years before and the way in which the business has been carried on now, there is so much of change. The traditional brick and mortars are in some cases has been shifted into e-commerce models. So therefore, a precise definition cannot be framed for business connection. Even if one were to make an attempt to define business connection, there could always be a possibility of keep amending those sections. So therefore, what the court have felt is it also changes depending on the facts and circumstances. So therefore, we will move away from defining what constitutes a business connection. Rather, we will only interpret the term business connection based on the facts and circumstances of each of the case. And there are enough number of precedents from the past, like from 1922 Act till now, to easily define or rather easily understand the phrase business connection. And we do have some of the old circulars from the department where they have clarified in several situations what are the activities that could encompasses the term business connection and what could not be called as a business connection. Technically, in case of a purchase or a sale transactions, the department has clarified that a purchase or business transactions in a ideal situation could constitute business connection, but nevertheless, if it satisfies certain parameters, say for example, the purchase or sale between the non-resident and the Indian resident is on a principal to principal basis, and the transactions are carried at arm's length, then this particular situation may not constitute business connection, is what way back in 1964 they have clarified in some of the circulars. So those principles have been still followed in several rulings from the Act point of view. Mind you, whatever we are discussing today is purely from the domestic law point of view. You do have a treaty benefits in case of wherever India has entered into a tax treaty. Why? Because Section 5, if you look at, subject to the provisions of the Act, that subject to the provisions of the Act should yield to all other provisions. So therefore, your Section 90 subsection 2 provides you a benefit. Whenever India has entered into a tax treaty with any of the country, then to that extent, the provisions of the tax treaty or domestic law is beneficial, you can very well apply. So therefore, whatever we're going to discuss is purely from income tax point of view, because it is good to understand the charge is generally created under the Act. A treaty only in exceptional situation create a charge, but nevertheless, charge is always created under the Act. So therefore, the obligation whether is there under the Act or not is paramount importance. So therefore, we are focusing on this. After Vishal ruling, you do have one of the famous ruling from the Supreme Court in R.D. Agarwal, where they went on to define business connection. So this is one of the classic case which has been repeated by the Supreme Court in many of the subsequent rulings to understand the nuances of business connection, where they went on to say the expression business connection means something more than business. So there has to be some activity which has to be undertaken in India, either by the non-resident or through his agent. Then that activity should yield to profits or gains. Because the word used is connection, there has to be some element of continuity is required. A stray or isolated activity is not to be regarded as a business connection. We will come to the stray or isolated activity when it deals with SEP. Like I initially said, I am dividing business connection into two, a traditional business connection and then SEP constituting a business connection. So whatever we are discussing now is traditional business connection. Business connection may take several forms. Say, for example, the activity may be conducted by the non-resident in India through an agent, or he may set up a subsidiary, transact through that subsidiary, there are instances where the subsidiary is being treated as a permanent establishment even under the tax treaty, and in the form of branch, in the form of liaison office. Liaison office is a situation where an RBI approves you to open up a liaison office for acting as a communication channel between customers in India and the overseas foreign entity. But nevertheless, there are instances where the liaison office has crossed that Lakshman Rekha and carried on a commercial activity. So in those cases, the tax authorities have rightly held that the activity of liaison office could constitute a business connection as well as a permanent establishment by virtue of Article 5 of the relevant treaty. So therefore, those particular activity could be chargeable to tax in India. And the court has emphasized time and again whether there is a business connection is there or not must be determined based on the facts. Because the phrase business connection is used, there is an apprehension whether it includes professional connection or not. And the court in Barendra Prasad Rai has rightly upheld that merely because the word business is used, that cannot be interpreted in a restrictive manner. Rather, it has to be interpreted in a wide manner. So therefore, the aspect of business connection could include professional connection. Say, for example, a foreign lawyer coming into India and conducting some activity. Does it mean he can argue I am a professional, so therefore what act is envisaged is only a business connection and not a professional connection? The answer is no. He will be still subject to taxation in India. Subsequently, after 40, 60 years of jurisprudence on business connection, the Andhra Pradesh High Court in JVK Industries in 1998 went on to cull out several principles from various rulings and tried to put it in a form of easily understandable parameters with which we can understand what constitutes business connection and what cannot constitute business connection. So therefore, if you look at the manner in which they have highlighted, which we have already discussed in the erstwhile slide, a business connection should be between an Indian person and then a non-resident. It's a mixed question of fact and law, which has to be determined on the facts and circumstances, which is what the Supreme Court in R.D. Agarwal has said. It is too wide to admit of any precise definition, and it is well-known attributes. The attributes could be existence of close, real, intimate relationship and commonness of interest between the non-resident and the Indian person. Where there is a control or management or finances or substantial holding of equity shares, in those cases, there could potentially be a business connection. And finally, the court have said to constitute business connection, there must be continuity of activity or operations of the non-resident with the Indian party, and a stray or isolated transaction is not enough to establish a business connection. So these are some of the principles which has been culled out by the JVK Industries ruling by the Andhra Pradesh High Court, and this particular ruling has been approved by the Supreme Court in 2014. Then, from a Bombay High Court ruling, we did have the concept of an intangible business connection in the case of Volkswagen Finance Private Limited. The facts of the case goes like this. Volkswagen India wanted to promote this one of the upcoming vehicles. So what they did is they conducted a show in Dubai. For the purpose of conducting the show in Dubai, they have engaged a Hollywood actor, Mr. Nicolas Cage, to come and perform in the show which they have been organizing. The end customers of the product which will be attracted is all from India. So close to 100-150 people from India went to Dubai to participate in this product launch where Mr. Nicholas Cage going to come and perform. So he will meet and greet all the participants, have a 30 minutes interview in the product launch. So the question is the payment made by Volkswagen Finance Private Limited to Nicholas Cage, whether subject to taxation in India or not. The tribunal went on to say this. If you look at the entire structure of this arrangement, the product is going to be launched in Dubai. All the end customers or the potential customers or the market at which it's going to get sold is in India. And for the purpose of this particular product launch event, you're not attracting any global customers. Rather, 100 to 150 people are traveling from India. So therefore, there is some sense of intangible which is there, which connects the India. So therefore, this is nothing but an intangible business connection. I beg to differ on this particular point on slight a deviation from our fundamental understanding. If you look at the purpose of section 9, you are looking at the taxation of a non-resident, right? So therefore, if there has to be any business connection between the non-resident and then the economic allegiance with India, so then the nexus which you are tracing it through business connection, there has to be some aspect of activity that non-resident either has to conduct on his own or he has to conduct on his own or through an agent. In this case, there is no part of activity conducted by Mr. Nicholas Cage in India. So therefore, it is very difficult to formulate a business connection when it comes to this particular transaction. But nevertheless, there is a theory behind this particular ruling is because entire business of the payer is economically situated in India and merely for the purpose of this product launch, you have gone out of India. So therefore, I sense a sense of intangible business connection. But nevertheless, we have to see how the High Court is going to deal with this particular aspect when it comes to intangible business connection. Exceptions. Where do this exception comes from? If you look at 9.1, I'll read the section, then we will move on with that explanation. 9.1, all income accruing or arising, whether directly or indirectly, through or from any business connection in India, or through or from property in India, or through or from any asset or source of income in India, or through or transfer of a capital asset situated in India. Now comes an explanation. For the purpose of this clause, in case of a business other than business having a business connection in India on account of SCP, which we will deal it with in a separate manner, the income of a clause B, if you look at explanation 1, clause B, in case of a non-resident, no income shall be deemed to accrue or arise in India to him through or from operations in India, which are confined to purchase of goods in India for the purpose of export. So therefore, if the activity of non-resident in India is confined only to purchases, then by virtue of explanation 1b, although you have undertaken a significant activity, it provides for an exception. Mind you, this exception will be available only if you purchase the goods for export. But if you purchase the goods for resale in India, then this particular exception or exemption may not be available to you. Now, one interesting ruling, if you look at exclusion of purchase for export, like I pointed out in the beginning, section 9 will apply only if the income or of the non-resident accrue or arise outside India. If the income is already accruing or arising in India, then the scope of section 9 cannot be invoked. This particular aspect has been dealt by section under section 9 by the authority of advance ruling in the case of Mushtaq Ahmed, where what has happened is this particular person had a proprietary business in Chennai through which he was selling some diamonds. He has set up one company in Singapore. As a part of same proprietary business, he's been identifying some customers and then making purchases for export to Singapore company. He argued before the AAR that I maintain two separate books of accounts, one for the proprietary business in India and second for the purpose of export. So therefore, with regard to the transaction between him and the Singapore company, I should be granted exception or exemption under explanation 1B to section 9. The AAR said this, if you look at the manner in which this exception is being given under the Act is only if the non-resident were carrying out an activity confined to purchase. So my activity should be solely for purchases. Whereas in this case, he has already have a proprietary business through which he is doing a trading activity, purchasing of diamonds and selling diamonds in India. As a part of the same activity, if he is carrying some other activity, then this particular exception is not available because that particular non-resident is already carrying activity in India. By virtue of it, income is already accruing or arising in India. So therefore, the question of me invoking section 9 does not arise. That is the principle the AAR had held. Now, another interesting ruling is on the Mondient Orient Limited, where the Karnataka High Court dealt with this explanation in a case where a branch which was providing services to foreign company as well as to the third party buyers. So therefore, the question is, if I'm providing services to my foreign company, which is the head office, as well as to the third party, although it is confined to export, whether this particular transaction is entitled for this exception under explanation 1B. The Karnataka High Court has said that explanation 1B should not be read only with regard to a qua non-resident, it is qua any non-resident. So therefore, this particular exception is allowable across. So therefore, one significant ruling where an exception under explanation 1B was conferred upon the non-resident. Now, the second exclusion, if you look at in explanation 1, exclusions for news agencies for shooting of cinematography. If your activity is confined only to this, then despite there could be a business connection, there cannot be any attributions at all. Your activity is not regarded as a business connection otherwise. These are some of the precedents when it comes to continuity and real and intimate connections. Like I said, business connection was introduced in 2003. It is defined in an inclusive manner. So still the court-based interpretations do exist, but nevertheless Act want to introduce some aspect of business connection which is equivalent of a dependent agency concept under the tax treaty. Now, if you look at the definition on the left-hand side before 2018 versus after 2018. Now, if you look at this before 2018, this is a traditional agency-related concept. For the removal of doubts, it is hereby declared that business connection shall include, so it is defined in an inclusive manner, any business activity carried out through a person who acting on behalf of non-resident. So naturally, if I have to act behalf, then it is a question of principal agent relationship, like how we deal with section 194H or the agency concept emanating from Indian Contract Act 1872. Now, there are three set of activity if an agent does, which could postulates into a dependent agency PE, by through which you do have a business connection in India. The agent has and habitually exercise in India an authority to conclude contracts on behalf of non-resident, unless his activities are limited to purchase of goods or merchandise to the non-resident. Why this exception was earlier there? If you look at any issue of explanation 1B, if the non-resident were to directly engage in any purchase of goods for exports, that particular activity is not regarded as a business connection. So if I directly involve, there is an exception. Why not that exception be equally granted if I carrying on this activity through an agent. So therefore, this exception was there. Then the second limb, while in the first limb you did have an authority, whereas in the second limb you don't have an authority, but you habitually maintains a stock of goods or merchandise from which the agent regularly delivers the goods on behalf of the non-resident. Then the third limb, which talks about habitually secures orders in India, mainly or wholly for non-resident or other non-residents controlled by or subject to common control. So therefore, I will look at group as a whole. Say for example, group, there is a company situated in US. It has multiple subsidiaries in the European region. If an Indian company is acting as an agent for US company, is also acting as an agent for all other European companies, then all these things to be clubbed together and I will look it as a group, whether I am a dependent agent or not. Now on the right side, if you look at lot of amendment has happened. If you look at the first limb, earlier has and habitually exercise in India an authority to conclude contract on behalf of non-resident. Now, if you look at on the other side, after the 2018 amendment, has and habitually exercise in India an authority to conclude contract, which is remaining as it is. Now, if you look at that exception, unless his activities are limited to the purchase of goods or merchandise, has been removed because India felt that this particular activity of purchase is most abused in most of the cases. So therefore, I will not grant exception or exemption to this activity. Mind you, the exemption under 9(1), explanation 1B is still there. Only with regard to explanation 2, which is with regard to agency concept, this particular exception has been removed. Now let's look at the bold line item. Habitually conclude contract or habitually plays principal role leading to conclusion of contract by non-resident. And that contracts, whether or not it is in the name of non-resident, it doesn't matter. For whether already owned by non-resident or is going to acquire that, it doesn't matter, or for the provision of services by non-resident. So if you look at a significant change has happened from conclusion of contract to playing a principal role leading to conclusion of contract. This is mainly happened on account of the WEBS action plan, which circulated in 2015, where action plan 7 dealt with various abuses that are prone in tax evasion or rather tax leakages when it comes to permanent establishment, where they have said this many situations where agent is playing a dominant role in a conclusion of contract, but ultimately the contracts were concluded by the non-resident. But nevertheless, the role played by the agent in a source country is so significant that that could possibly trigger a permanent establishment. So therefore, we borrowed those principles from the Action Plan 7 and then incorporated it as part of the Domestic Act. Why it is so important is if tomorrow your tax treaty, or rather it has already changed many of the tax treaties on account of multilateral instruments, if your act, domestic law, were to retain the same definition as that was before 2018, then by virtue of section 90 subsection 2, any non-resident would like to apply the domestic law to say that, okay, domestic law is now more beneficial, so you apply domestic law. So therefore, despite the agent playing a dominant role, by virtue of a treaty, you may trigger a permanent establishment, but by virtue of a domestic law, you fall short of a business connection. It should not happen in such a way. So therefore, a domestic law was amended. With regard to the other two conditions, if you look at habitually maintains in India a stock of goods or merchandise or habitually secures orders in India was retained as such. So the need for amendment, which I have already highlighted here, key terms which you are already aware. Say, for example, when it comes to agency, I have to act on behalf of. And the word habitually, we have to distinguish that from the word regularly. It is different from regular. Habitual is I have to look at the frequency. Regularly means, say, for example, I'll do 100 odd times. Within a particular financial year, I'll do 100 odd times, I will go and conclude a contract. Whereas habitually need not to be 100 odd times. It's fall short of regular. One has to be very, very mindful of different treaty languages also mentioned, but nevertheless, we will confine ourselves to the domestic law for the time being. And when are the situations where a person is said to have authority to conclude contracts? He has sufficient authority. The principal has already given an authority that I have given you a power of attorney. So you go and sign up the contracts. It's a situation where the agent has a authority and he is also exercising that authority. Agent can act independently without any supervision or direction from the principals. So therefore, there is no exercise of or element of control which has been put in place by the principal on the agent. Agent is authorized to negotiate all elements of the contract. Where approval of contract by the foreign enterprise is only a formality. Lack of involvement by an enterprise in a transaction is an indicative factor that agent has given a full authority. So there are instances where if you look at an agent and principal goes together for a meeting, this gives an indication or an impression that agent is also actively undertaking part in the meeting. So therefore, potentially he will have an authority. So therefore, these are all fact-specific exercise. If you look at predominant rulings from a dependent agency PE point of view, I'm still going and taking some of the principles from PE perspective. It is mainly because this particular issue will come when it comes to marketing agents. We have to interplay this with the GST concept where you do have an intermediary. So therefore, if there is a provision of GST which is applicable on an intermediary, whether it will equally trigger a dependent agency PE, consequentially a business connection or not, is an important interplay that we have to be mindful of between GST law and then the income tax law. Principal role leading to, like I said, if you look at, let's say 10 elements of contract are there to be negotiated. The agent negotiates 7 critical elements, but 3 critical elements or rather 3 elements, say for example, timing of delivery. If it is not so critical, timing of delivery and then signing of contracts is done by the foreign principal. Then if the principal role leading to conclusion of contract is absent in the domestic law, the agent will very well argue that, hey, look at, I don't conclude the contracts. The conclusion of contract is done by my principal because he is the one who is going to sign the contract. Or envisage a situation where I dictate 5 or 6 terms. Whatever the 5 or 6 terms which has been negotiated by the agent are the only critical elements. Some of the incidental elements were negotiated by the principal. Can someone say, as an agent, I have not negotiated all the contract. I have negotiated only part of the contracts, although it is very critical. But nevertheless, it played a principal role. So therefore, in these sort of circumstances, because of the wordings of the section you have now, it is impossible to escape that agent has not played a dominant role. So therefore, we have to look at the facts as it is to understand what is the role of the agent, what sort of communication that the agent conducts with the customers as well as with the principals, and how are the communication happens between the principal and then the customers in India. Is it only channelized through the agent, or is there direct way of interactions between the foreign principals and the customers in India? Say, for example, whatever the terms that has been negotiated by the agent. Say, for example, even if I do 5 critical terms, whether the foreign principals blindly accepts that 5 critical terms or it put some sort of due diligence onto the terms that has been negotiated by the agent later on. Based on that particular due diligence, it exercises authority. The foreign principals on a standalone basis exercises authority and then make an approval. If it's merely a rubber stamp, then the Indian agent is the one who's doing a principal role leading to conclusion of contract. But if it is not a rubber stamp approved, if you are able to establish the foreign principal is exercising due care and diligence in approving all the orders, then possibly the principal role may be toned down. So if you look at the last part, a person who negotiates in a state all elements and details of a contract in a way it binds the enterprise can be said to be the person whose principal role leading to conclusion of contracts. This is some of the important aspects. If you look at, I quoted the para number from OECD, but nevertheless, if you read the action plan 7 of 2015, you will get good amount of answers from it. So I'm touching upon this on a bird's eye view basis. There could be several numerous example situation could be there. Even if you look at some of the Indian jurisprudence on a dependent agency, majorly, if you look at the marketing agents have been compensated on a profitability model. Say, for example, number of customers you brought in, based on that, the number of revenue pulled in, based on that, the appraisals have been laid out. Based on that, you have been remunerated. So therefore, it gives an indication that the agent or the marketing support service provider in India plays a dominant role. If you look at most of these rulings where the LinkedIn account, the employee appraisal documents, all this been put on record by the department to show that the Indian agent is actually undertaking the important activities. So these are some of the precedents from an authority to conclude a contract perspective. An independent agent is one. So now we have looked at dependent agent. Act itself, you have a concept of an independent agent. When I am not a dependent, I have to then argue otherwise, I am independent. So dependent agency is a situation where it could either lead to a business connection or a permanent establishment. Then the question of attribution to taxation in India arises. But if I were to show that I am not a dependent, then how do I show I am an independent? There are 3 important aspects one has to consider. If I have to establish that I am an independent agent, then whatever conduct that is the agency business which I am doing, it should be in the ordinary course of business. So the risk and rewards pertaining to that business should belong to me. Whoever comes to me, I will do this agency business is one thing. Then second set of dependents will be looked at more from a legal perspective. Say, for example, to what extent the control on the agent is exercised by the principal. If the control, supervision, or directions is exercised is so critical, then by virtue of the control aspects, I may fail the independence test. So therefore, I have to establish that I am not subject to a detailed control or a detailed direction. The freedom is given to the independent agent to act in his own manner. Of course, I should not. So even in this case, if you look at, I conclude contracts. I'm an independent agent. I'm not a dependent agent. So if I'm subject to a detailed instructions, okay, this is how you have to go and speak to the customers. This is a manner in which you have to incur your promotional expenses. If these are the directions and supervisions has been coming from the foreign principal, then I will not be able to regard myself as an independent agent. Then the third aspect is the economic independence. Economically, am I dependent on one person? Say, for example, even if you are not related at all, if you are a third party dealing with the principal, even in the ordinary course of business, but if you are economically dependent on one particular principal at all, if tomorrow that particular principal stops the business, whether you will be able to sustain on your own is an important factor one has to be considered. If you are economically dependent, then you will not be regarded as an independent agent. Then how do I say I am economically dependent or not? There is no prescribed threshold. Say, for example, you look at section 222, deemed dividend, where they have given a threshold of 10% or 20%. Likewise, if you look at indirect transfer or 50%, you do have section 79, 51%. There is no such threshold has been prescribed. But if you look at in one of the AR ruling in Specialty Magazine, where they have said 90% is the criteria to determine, because the word they have used is only or mainly in this section. So therefore, if you are 90% of the income is coming from a single principal or group of principals controlled by the same person, then you are not economically independent. There is slight difference in the language between the explanation 2 vis-a-vis MLI, which I have highlighted here. If you look at explanation 2, the first proviso talks about ordinary course of his business, whereas in MLI, Article 12, it talks about ordinary course of that business. So what is the difference between his business versus that business? Here, if you look at his business, you are looking at an entity as a whole, person as a whole. Whereas when it comes to that business, you are carving out agency business alone. Say, for example, if I am having trading business and agency business, then for the purpose of testing economic dependence, should I clump both this activity together or should I look at agency business alone? The language in the act suggests this business, so therefore possible interpretation is I have to combine both agency and distribution business together, whereas in MLA it categorically says his that business, so therefore it is only agent business. But nevertheless, my view is even under the act you have to look at only agency business, because that is the business for which you are testing dependency. So therefore you cannot combine agency or and distribution business together to look at economic independence. But nevertheless, there are two divergent rulings from the judiciary. But nevertheless, on a principal basis, you should not combine some of the independent agent related rulings which I have highlighted here. Explanation 1A, which talks about attribution. If you look at explanation 1A, where it says in case of business, other than business having business connection in India on account of SCP, of which all the operations are not carried out in India, income of a business deemed under this clause to accrue or arise in India shall be only such part of income reasonably attributed to operations carried out in India. So therefore, if there are several operations for a particular business, out of which, let's say 10 operations, 8 operations are carried out outside India, 2 operations are carried out in India, then under the traditional business connection, only these 2 limbs are subject to attribution. You can't attribute the entire income in India. So therefore, the attribution is limited to activities that are undertaken in India. Now, if you look at with regard to SCP, it excludes business connection on account of SCP. So therefore, the choice of attribution only with regard to activities attributable, reasonably attributable to operations carried out in India is not there for SCP. It is confined only to a business connection. This is in summary the traditional business connection. Moving on with regard to significant economic presence. This came out of Action Plan 1, where many of the foreign companies have been undertaking digital transactions in India, more of a market centric. If you look at the business connections or a permanent establishment as per the tax treaty, those are all based on demand side, or rather it is based on the supply side, where it focuses on the entities which are manufacturing or entities which are providing service or trading. It is never a market centric. All your e-commerce transactions is focusing on market centric. Customer is the one derives more value. So therefore, there has to be some sort of nexus should be there. See, in case of a business connection, the nexus has been established based on some sort of a presence either on your own or through an agent. When it comes to digital companies, this particular nexus is missing. Say, for example, Facebook. All of us use Facebook, right? There is no intermediary which is involved. The non-resident, even without any LO or branch office, without that physical presence, able to attract customers. Although Facebook do have an office in Hyderabad, but nevertheless, if you look at, there is no interaction between an Indian person or an intermediary who acts as an interface for the overseas entity and the customer. So therefore, how do I then create a nexus? There were 3 propositions which were deliberated in the Action Plan 1, out of which India has picked up a proposition on a digital factor. So if you look at the 2015 report, there were 3 it is per se not a recommendation. Options were discussed. 1, you do an equalization levy, or you superimpose some sort of a withholding tax, or third is some sort of a nexus has been created based on twin parameters. These twin parameters are mutually inclusive, transaction based and digital factors. What India did is we borrowed that particular, although it is not recommended for any of the countries. Until 2018, nothing has happened with regard to Action Plan 1. In 2018 March, they have only published an updated note where they have discussed several issues, further issues from e-commerce companies. And in 2010, it moved into a direction of a 2-pillar solution, Pillar 1 and Pillar 2. Now still discussions and negotiations are being still going on between the inclusive framework. Now India has taken up 2 aspects. In 2016, they have adopted equalization levy for online advertisement related transactions. And 2018, they borrowed that nexus theory and applied into the domestic law in the form of a significant economic presence, where the twin conditions of transactional limit and the digital factors, while it is mutually inclusive when it comes to the Action Plan 2015, we made it as a mutually exclusive. So therefore, either or conditions has been put in place in 2018. Now, if you look at the left-hand side, is the 2018 amendment, and then on the right-hand side, the 2020 amendment. If you look at explanation 2A, for the removal of doubts, it is hereby clarified that significant economic presence of a non-resident in India shall constitute business connection in India, and significant economic presence for the purpose shall mean. Just look at the highlighted parts as well closely. Transaction in respect of any goods, services, or property carried out by a non-resident in India, including provision for download of data or software in India, if the aggregate payments arising from the transaction exceeds such amount as may be prescribed, or systematic and continuous soliciting of business activity or engaging in interaction with such number of users as the case may be prescribed in India through digital means. So this is what initially envisaged. Now, if you look at the starking difference that you have when it comes to this particular thing. If you look at in 2018, there has to be a transaction which the non-resident has to carry out in India, or he has to solicit some sort of business or engage in interaction with users in India through a digital mean. So therefore, some bit of activity the non-resident has to undertake in India as per the transaction limit, or through a digital means he has to engage in interactions with the users. Now, if you look at 2020 amendment, transaction in respect of any goods, service or property carried out by a non-resident with any person in India. So before in India, they have included a word with any person in India. So which means if you look at the non-resident need not to carry out any activity in India. A mere transaction with any person in India is sufficient to trigger a transaction-based SCP if the limit has been exceeded. Now, limb B, if you look at systematic continuous soliciting of business activity or engaging in interaction with such numbers of users in India. So therefore, through digital means has been removed. So even if you normally do like a conventional method, as long as it exceeds the threshold prescribed, it could trigger a SCP, which is based on the limb B. So in July 2022, the CBDT has notified the limits for limb A and limb B. When you look at limb A, the limit notified is 2 crores aggregate. When it comes to limb B, 3 lakh users has been notified. And there are some factors which the Act says these are all irrelevant in determination of SCP. What are those factors? If you look at the place of entering the agreement, whether the non-resident has place of business in India or not, whether non-resident renders service in India or not, provided that so much of income as is attributable to transactions or activities carried out in Class A or Class B shall be deemed to accrue or arise in India. So you see the starking difference when it comes to a traditional business connection. There has to be an activity of a non-resident in India, either on his own or through a agent. Whereas when it comes to a business connection, you don't need a mere transaction with a person in India could trigger. Well, let's look at what are the issues which each of this link could have. Like I pointed out, in the OECD 2015 action plan, transaction-based along with digital users has been looked at as one single nexus. We are using it as a 2 different nexus. SCP is mutually exclusive from traditional business. So in such a manner, if a non-resident has carried out an activity in India, either on his own or through an agent, then I will look at traditional business connection. If the non-resident is not carrying out any activity in India, either on his own or through an agent, then I will look at SCP. This is how I mutually distinguish these 2 business connections. If there is an activity carried out in India, then I will apply business connections. If there is no activity in India, there is no need to apply traditional business connection. I will only apply SCP. Otherwise, if I were to apply SCP in irrespective of the manner of the activity undertaken in India, then the purpose of having a traditional business connection is lost. So I should interpret in an harmonious manner so that both the sections can be interpreted properly. Limb A covers all modes of transaction, goods, property, services. So therefore, it is so wide. You look at provision for download of data or software is in India. There is already a dispute with regard to software taxation in India. By virtue of explanation 3 or explanation 4 to royalty definition, India wanted to cover software also. But my point here is, it is only a cautious manner they have included as part of this. If someone were to download the data from a software, then possibly they may get they get caught in SCP. Whereas if they are downloading the software, they might possibly get caught under the royalty definitions. Even a stray or isolated activity, if you look at the earlier discussions, a stray or isolated activity may not fall under the definition of business connection, whereas when it comes to SCP, even a stray or isolated activity could possibly fall under the definition of SCP, provided I cross the threshold of 2 crores. Aggregate of payments. So how do I then look at? On section 5, we have the concept of accrual or arisal, whereas here, payment arising from such transaction. Is there any difficulty in this interpretation? So what happens in a situation where an accrual has happened in 1 year, but payment has happened in subsequent year? If one were to argue that, okay, I will go and look at only the payment date as the basis for determining SCP, then in the year of payment, say for example, an SCP is triggered, but there is no income for the non-resident in that particular year. So therefore, I feel to harmoniously read, payment doesn't mean an actual payment. The year of transaction is what one has to look at when it comes to determining the limit of 2 crores. What happens to a scenario where, say for example, like I highlighted in the initial discussion, you do have explanation to section 9 subsection 2, where the priority of application is there in respect of a particular income if it falls within royalty, FTS or interest, irrespective of the non-resident as business connection or not. So what happens in such a case? Say for example, I sell 1 crore 90 lakhs of goods in year 1. In the same year, I also have a royalty income of 60 lakhs. If you look at overall, the transaction is 2.5 crores. If someone were to argue, no, nothing doing, the royalty is already being taxed under 916. So therefore, I should not include the same amount for determination of SCP. Because SCP, if you look at goods, services or property is anyway covered. Property includes tangible or intangible. If one were to include the royalty, it could lead to absurdity. So I have to respect the generalia specialibus maxim, because a royalty transaction is anyway taxed under 916. I cannot include that particular transaction again for the purpose of determining the SCP limit. So therefore, I have to look at only those transactions which are falling under SCP, not under any of the other provisions, is one way of looking at it. Now, limb B, systematic and continuous. So therefore, the moment the word systematic is being used, if you look at the word systematic is also used in section 94A in a negative connotation. Here it is used in a positive connotations. So therefore, systematic is some sort of planning or some sort of exercise. And then the word continuous, like how we read in business connection. Connection means there has to be some repetition. So when it comes to limb A, possibly straight transactions may fall, whereas when it comes to limb B, there has to be a systematic and continuous. So therefore, something is preconceived, something is planned, and then it is continuous. Say for example, nowadays, if you look at, we receive many of the calls from the insurance agents or even for the bank. Hey, do you want a personal loan? There are so much of policies available. So the calls get repeated. So therefore, it involves some sort of a systematic and continuous. Engaging in interactions. What constitutes interaction? It is a one-way or a two-way traffic. Say for example, you enter into a discussion with ChatGPT. You ask questions, it responds. You ask questions, it responds. there are occasions where there are some websites, the moment when you, classic is the revised website of the income tax department. You do have a specific icon, which is the support center, where it will enables you to identify certain items. So there's an interactions. Whether an interaction could be through a robot or it could be through a person, it doesn't matter. But there has to be an interaction. Now all that happens. It talks about users. How do I then determine user? Whether it is an active user or a passive user. Say, for example, whenever I watch YouTube, or even whenever we enter into social media, sometimes we wrongly click a particular advertisements. It immediately takes to the product which it wants to show you. Your intention is not to get into that particular link and to view the product, but by mistake you have done it. So therefore, are you an active user or a passive user? What has been intended in the explanation to a limb B? One has to look at 2018. Whether it is binding or not is nevertheless, but it's good to read the interim report of the action plan 1, where they've bifurcated between active and passive users. How do you then identify passive users? Is some sort of a, or versus active user is based on the interactions or based on the time that you spent on a particular app. Act of solicitation was an interaction. Does it generate income all the time? Say, for example, we engage in a lot of interactions in the social media. What is the income that the social media company generates? It generates so much of value of data or content, the amount of time you spent on a particular platform. Based on that, they are able to derive some sort of a data pool which they can sell it. Say, for example, Facebook sell a lot of ads. They generate ads based on the data that you derive from the users. Users has been interested in these sort of products. I have this amount of data, a million amount of data of crores of users in India, where you can advertise. I can give you the data. You can, based on that, design an advertisement and place it on record. So I will put it on my website where it enables to propagate your products to 1 crores of users. So the user data enables the company, that is a non-resident, to derive advertisement revenues. Based on that, for example, if any products has been sold, say you looked at YouTube, you saw an ad of an Amazon particular product and you go and place an order. Say, for example, you place an order with Amazon US and not Amazon India. Now, YouTube will charge an advertisement fee. This advertisement fee is taxable because it crosses so much of threshold of 3 lakh users. So therefore, income it generates is taxable by virtue of explanation 3A, which I come to it in a while. What happens if Amazon US sells a product? That particular transaction, if you look at, is anyway taxed by virtue of explanation 2A, limb A, because limb A deals with goods, service, or property. So the transaction with Amazon US and the Indian counterpart is anyway being taxed under limb A. The advertisement stream of income which the YouTube is deriving will possibly come under the aspect of an attribution by virtue of explanation 3A. If you look at, for the removal of doubts, it is hereby declared that income attributable to the operations carried out in India as referred to in explanation 1 shall include income from such advertisement which targets a customer who resides in India or a customer who accesses the advertisement through internet protocol address located in India, sale of data collected from a person who resides in India, sale of goods or services. Anyway, sale of goods and services using the data is covered under limb A. But you look at limb 1 and limb 2. This is a way, say for example, in the same case, YouTube engages with 3 lakh customers or rather 1 million customers. It pulled up data, but in the subsequent year, it sells the data. Whatever income that is sold in the subsequent year will be on account of the business connection I heard in the earlier year. So therefore, I will be able to determine a nexus between the two. So this is one critical aspects we have to look at from a explain. I'm just skipping this for a moment just to conclude quickly on transfer of capital asset in India. With that, the business connection will get over. Deepika, how much time I have? Can I take 7 to 10 minutes
Yes,
to
sir.
close on this particular?
Yes, sir. You can take 7 to 10 minutes. We have a couple of questions lined up.
Yeah, sure. So if you look at the fourth limb of transfer of capital asset in India, so what happens in this case? There is a situs of capital asset in India. Say, for example, when it comes to capital gains, all of us go looks at section 45. The computation has been provided. 214 defines what is a capital asset. Section 47 determines what is a transfer definition. So all of us combined together, there is a capital gain. Now, when it comes to capital non-resident may sell the shares of an Indian company to another non-resident. The agreement may be entered outside India. The payment may be paid outside India. The recipient is maybe paid. A recipient of the shares is also outside India. So therefore, the point of accrual is outside India. Then how do I create a fiction to tax this particular income? Is because of the capital asset situated in India. Because it's being an Indian company, if one were to look at the Indian jurisprudence in the context of Vodafone, where the Supreme Court held the situs of shares belongs to the place where the company is incorporated. So therefore, if the sale were to be the Indian company shares, then the situs is based on the incorporation of the Indian company, which is in India. So therefore, the situation of capital asset is a situs which creates a nexus between the transaction which was taking elsewhere outside of India to India. So therefore, by virtue of this, you're creating a nexus. Situs of intangible property. If one were to look at CUB-PTY, where they've said it follows the owner, whoever is the owner of the intangible, that is where the situs is. There are some different interpretations when it comes to this particular ruling, and it is pending before the Supreme Court. If you look at this particular maxim, mobilia sequentur personam, it is a Latin maxim where, for the purpose of convenience of levying estate duty, this particular maxim was used. But nevertheless, we borrowed that particular maxim for the purpose of determining the situs in the context of tax law, which is what the department is contesting, and it is rightly so, and it is pending before the Supreme Court. Indirect transfer provisions were introduced in 2012. Meaning of the term through. If you look at section 9, the through has been used in each of the 4 limbs. By means of or through our business connection in India, through our property situated in India, through our assets or source of income in India, or through from a capital asset situated in India. This through was discussed in Vodafone in briefly, where the Supreme Court has said that I will not look through. In effect, see-through structures is not possible because it was never envisaged under the Act. So therefore, to overcome that particular ruling, the explanation was introduced to expand or clarify the definition of through, which means in consequences of also has been added. Introduction of explanation 5, 6, 7 to determine the threshold of indirect transfers, the day in which I have to determine, and there are a couple of interesting aspects in explanation 7 where they have given exemption for small shareholders. At the same time, the attribution has also been described in section 7, explanation 7. Say, for example, if my foreign company derives value from India only to the extent of 70%, then the attribution by virtue of explanation 7b is limited to that 70%. Overseas dividend was clarified by Circular 4 of 2015. The intent is to not catch all sort of transactions which is falling under indirect transfer. Only those indirect transfer which results in transfer of a capital asset situated in India, only in those cases. Otherwise, whatever transaction that is happening elsewhere outside of India will get caught by virtue of indirect transfer provisions. I'm not going through the Vodafone decision, everyone is aware. Certain few nuances when it comes to explanation 5, 6, and 7. Explanation 5 may not apply to intangible asset because CUP PTY has clearly clarified. Even one were to look at the Shom Committee's report, where they have explicitly provided that it is not intended to cover intangible assets, because the way in which explanation 5 has been worded, it gives slight difference, but nevertheless, CUP PTY Limited has clarified this particular part along with the Shom Committee report. And it says, tax the gain derived from a transfer of capital asset outside India, which derives value substantially from assets located in India. Assets located in India has been defined to include step-down subsidiaries of the Indian company, which is whether it is in India or outside India, it doesn't matter, it gets covered. Now, what do you mean by substantially from assets located in India? 50% is the threshold which has been prescribed, and the value of asset located in India should be more than 10 crores. So these two parameters has to be satisfied. If the value of asset located in India is less than 10 crore, or the value of overseas assets to the value of Indian assets is less than 50%, this is mutually inclusive, both has to satisfy. Unless and until this condition is satisfied, indirect transfer provisions will not applicable under the domestic law. Specified date for determination of this 50% criteria is also prescribed. There are 2 dates. Depending on the conditions, the dates are applicable. And explanation 7, I said 5% is the threshold that has been prescribed for small shareholders. If your shareholding indirectly is less than 5%, it is not the transfer should be less than 5%. Your entire holding, indirect holding should be less than 5%. Then only you are entitled for this exemption. My session I'll open for questions, Deepika.
Thank you, Prasanna Sarji, for a valuable session. There are a few interesting questions. Rather, we have a lot of questions flowing in from the audience, but I would like to take only few because of the shortage of time. One of the session attendees wants to know about the precautions that has to be taken to comply with the income tax laws when we are dealing with this significant economic presence and the business connections.
See, 2 things one has to be looking at. One, what is when it comes to significant economic presence, see, you are not generally deal with the non-residents directly. Say, for example, if I'm a certifier of 15 CB, I will only deal with the Indian parties. If the parties to which the Indian party is dealing, the foreign company, say for example, if they are related, then I can very well understand what are all the transactions that the foreign company has with the Indian counterpart. But if the Indian entity and then the foreign entities are not related, then as a payer or as a certifier, I may not know what and all transaction that the foreign company has in India. Say, for example, when it comes to significant economic presence, you do have a limit of 2 crores. I may end up having a transaction of only 40 lakhs, whereas the non-resident may have several rounds of transactions with other parties. So one prerequisite I always advise is obtain a tax residency certificate as well as the Form 10F if required, because Form 10F is required in exceptional situations where your TRC does not contain relevant details as prescribed under section 90 subsection 5 and notified by rule 21 AA. So this is one, and then take a specific declaration from non-resident that they are not carrying out any activity in India. If it's a treaty counterpart, they are not having any permanent establishment in India. But if it were to be a transaction with a non-resident with whom India does not have a treaty, then one another way out is ask a 197 certificate from the non-resident, so as to be cover yourself from the any potential 201 proceedings. Yeah, Deepika.
One of the viewers wants to know about the flow of sections that has to be read in order to understand the NRI taxation.
See, there is no specific flow of section. If you look at, probably in my way of understanding is 4, 5, 6, 9 are all connected. Apart from this, there are specific sections from 115. You do have section 10. There are, when it comes to NRI, you do have certain exemptions. Say, for example, in case of a person who is not a citizen of India, who visits India for the purpose of employment, and his stay in India is less than 90 days, you do have a short stay exemption. So section 9, section 10, 115A, and then there are specific 115 series, 195, 196, section 90, and then treaty. Couple of interesting, if you look at, we Institute do have a publication on international taxation, which is a good publication. Even they have a publication for expatriate and then royalty or FTS. These are all good publications to have it in handy.
One of our viewers wants to know if there is when there is a foreign holding company and it converts the amount due from its subsidiary to the equity shares, will such transaction be considered as a transfer of capital asset?
See, generally, if you look at section 47, it gives exemptions for conversion of, let's say, debentures or preference shares into equity. It is not regarded that particular conversion as a transfers, right? When even FEMA, foreign exchange regulations, do permit for you in certain situations convert the payables into capital assets. So therefore, whenever there is a conversion between existing asset to another, say for example, debentures to equity or a preference to equity, there is a specific exemptions provided under the section 47. But when it comes to loan to equity, there is no specific exemptions which are provided under section 47. But nevertheless, the conversion happens at the fair market value. So therefore, there will not be any gain at all.
Last question, because we are running short of time. If there is an Indian agent who becomes a partner of an NOR, then what are the implications of the Income Tax Act?
See, the moment you become an Indian agent, right? Assume for a moment you become a dependent agent. Now, the first question is, are you being compensated at arm's length or not? Say, for example, when it comes to the determination of arm's length, there are multiple disputes are there. How do I then compute this arm's length? Whether I should apply transfer pricing principles or I should apply the Rule 10 related principles. One another question that generally comes up is that what is the functional profile of this particular agent? Say, for example, I am a market service provider and I have been compensated on a cost plus basis. And as per my transfer pricing document, let's say I have to perform 5 different functions. Now, P is not created on account of these 5 different functions. I performed activity 6 and activity 7, because of which a P is created, a dependent agency PE. Now, you look at from a perspective of the intragroup pricing in this case, I've been contracted to perform only 5 activities. I've been compensated for those 5 activities on a cost plus 10% markup. But what about activity 6 and 7? I never been compensated. So therefore, for that activity 6 and 7, the non-resident has to pay taxes in India. So therefore, there could possibly be a potential additional attribution. One were to look at the Supreme Court ruling in Morgan Stanley, where they have discussed this particular principle. If the existing transfer pricing principles is already sufficiently addressing the activities, say, let's say, for example, this cost plus 10% arm's length is already imputed the two activities which leads to PE. Say, for example, activity 6 and 7 is already been factored when it comes to the ALP related pricing, then there is no need for a further attribution. But if the activity has not been considering the activity 6 and 7, which leads to a PE, then there is a requirement of a further attribution. So therefore, one has to be mindful of what is the nature of the remuneration that I have agreed as an agent, whether that sufficiently covers the PE related attribution if at all something happens or not. Otherwise, non-resident is subject to taxation at 40%, whereas you as an agent, you might, let's say if it's a company and if you opted for new regime, you will end up paying tax only at 25%. So there is a gap of 17%.
Thank you, Prasanna Sarji, for your valuable information. And it was really a very engrossing session. Thank you for sharing a drop of your ocean of knowledge. Thanks a lot. I extend my hearty welcome, hearty congratulations to you on your feat, and hope to listen to you more often, and even extend my hearty wishes to everybody present here. I would like to thank the DTC committee of ICAI, our chairman, CA Piyush ji, and our vice chairman, CA Kota ji, and our leading light, SP Singh sir, for guiding this session and hosting this session. Lastly, I would thank the technical staff, Prachi Jain, as well as the tech support team for arranging such a valuable session and enlightening all the faculty members.
Thank you. Thank you, Deepika ji, for the warm regards. Thanks to the committee as well as to the chairman, vice chairman, and the moderator, SP Singh sir, for this opportunity. Thank you. Thank you so much.
Thank you. Nicely done. It's a very nice presentation, Prasanna ji.
Thank you. Thank you, sir.
Thank you, Prasanna.
Thank you, sir.